Hi, Dominique, and welcome to another edition of The Week Ahead. How are you doing?
Very well, thank you. How are you, Andrew?
Good, good. So excited to get going. Yeah, so let's, as we always like to do, let's kind of review your kind of thoughts and takeaways from any kind of political or Fed speeches, market reactions, and obviously data. Certainly from probably all aspects of that, was an interesting week. What were your kind of biggest takeaways?
So, of course, the biggest event was a deal on the debt ceiling. I was surprised that the Republicans didn't try to do more damage because the Democrats got a good deal, no debt ceiling standoff until after the 2024 elections, in exchange for about a quarter of GDP worth of cuts in expenditures. So they took it, and they were right to take it. There were more Democrats who voted for the bill in the House, Republicans, and that tells you everything. And now the big question is the rebuild of the TGA, the Treasury checking account at the Fed. On Thursday, it was 20 billion. So I think, Secretary of the Treasury Yellen was correct that the ex-date is Monday. And by the end of June, the Treasury wants to build it to 550 billion, while the Fed will be shrinking its balance sheet by about 100 billion. So I think it's impossible to do that without exploding the money markets. The street thinks that it's all going to come from the Fed reverse repo, and that banks' reserves won't be affected. I actually disagree. I mean, if you look at the interest rate that banks are paying on deposits, it's not moving much, and it's telling you that either banks cannot afford to pay more or are not willing to pay more because they have enough deposits. Probably a mixture of the two, but the bottom line is you still have substantial flows towards money market funds, and it's not clear with the prospect of a hike in July, or I mean, probably not this time around, but in July, it's not clear that they will be more willing to buy treasuries and to keep their money safely tucked in at the Fed reverse repo. So we'll see. This week, we are going to have huge issuance, and we're going to have a sense of the market capacity to absorb this issuance.
Well,
So
why do you think banks are not? Yeah, just to clarify that. So why do you think, especially kind of more, regional or medium-sized banks are not raising the rates they pay depositors?
because
You're saying like you think it could be because they can't afford to, but there's going to be competition, so they would lose money to, I guess, to banks that do, or obviously to money markets. It is strange. By the way, I think it's the same thing here in the UK. I mean, my bank pays like 1% or something for checking or savings account.
So I don't know about the UK, but in the US, if you look at a traditional measure of bank liquidity, like the loan to deposit ratio, it's still way, below pre-pandemic, when liquidity was already very ample. And so banks are still digesting the enormous amount of reserves and deposits that was stuffed onto their balance sheet. So they still have, in my view, they still have too many deposits. And that's why the gap
Demand is not
there's
that
no
high for the reasons that we said, which so we believe the market or some market participants misinterpret the fact that if loan demand is not super strong, that doesn't mean like businesses are in bad shape. In fact, it may mean the opposite. Right?
Exactly. Businesses want to deleverage.
And then this issue around liquidity over the next week or couple of weeks. Somebody forwarded me that from a few of the banks that JP and Citi, I think, talking about this could be a very negative effect. Certainly on the equity markets and I guess on like high yield credit. And you actually talked about a bit in one of your pieces, why you don't necessarily agree with that. And I guess there's twofold. One is there are different environments when that's more relevant and not. And then there's also a question about QT continuing.
Well,
Yeah, so
the bottom line is, and I think everybody agrees on that, the Fed and the Treasury are not going to crash the money market. And the sort of liquidity decrease that we are talking about, which is about between RRP and reserves, 600 billion decline over 4 weeks, it's going to crash the money market. So I think the Fed, so obviously neither the Fed nor the Treasury are targeting risk asset. But I mean, with banks a little wobbly, there is no way the Fed is going to place the bank in a liquidity squeeze. And the idea is that the banks would be able to borrow from the permanent repo facility. Makes no sense when you have a banking crisis. I mean, there is, in the current environment, there is a stigma attached to going to the permanent repo facility. And banks are not going to do it. And even if banks were doing it, what you'd probably end up in a situation where the expansion in the permanent facility is big enough to offset QT, so that the Fed assets are expanding. Which brings me to my earlier point. Neither the Fed nor the Treasury want to crash the banking system. So they are going to stop the withdrawal of liquidity when it becomes clear that money markets are under strain. I'm not sure if it happens this week, next week, but over the next 4 weeks, if they go ahead with their plans to remove 600 billion of liquidity, it's going to have a market impact.
Yeah. So you think if there is real kind of liquidity issues in the markets, the Fed and the Treasury will just adjust accordingly? And is that the reason why you think equities won't sell off as others predict? Or is there other reasons? Yeah.
So if you look at the relationship between reserves and equity, there are times when the two have been quite tightly correlated. So particularly during periods of high risk aversion and uncertainty, 2009, 10, also the pandemic, so 2020 to the middle of last year. But there are times when reserves have been shrinking and equities have done well. I'm thinking of 2018, 19. Yes, there was a sell-off in 2018, but the sell-off had to do with concerns that the Fed was going to continue to tighten, that we were moving towards an environment with a higher nominal GDP growth where there wouldn't be a need for QE. But as soon as the Fed announced they were easing policies, miracle of miracle, the market recovered. So I don't think it's a liquidity. I mean, I'm looking at growth. Growth is strong. The Fed is clearly intent in burying its head in the sand as far as inflation is concerned. Strong growth, no inflation. Usually equities do well in that environment, unless, of course, the Fed is intent on crashing the markets, the money market, which I very much doubt.
And so why would it crash the money markets?
If they go ahead with the plan to shrink the asset side of the balance sheet by 100 billion, that's the Fed, and the Treasury plan to increase the TGA by more than 500 billion. So between the two, the RRP and reserve gets squashed And there is about 600 billion that goes away in 4 weeks. That's crazy. It's not going to happen.
Right.
We'll see. In these words.
And then generally, market movements over the past week, does it all make sense with debt ceiling and obviously with payrolls, anything like, were you surprised, maybe risk being so strong even on Friday after seemed like at least a fairly strong report, but.
Well, I mean, the debt ceiling got resolved without an impact on growth, basically. The Fed, so we had Vice Chair nominee Jefferson, who turned around, I mean, having said something hawkish 10 days ago, turned around and suddenly turned dovish, even though the data has been very strong between his two public speeches. So what's not to like? Strong growth, no Fed tightening, fantastic. Yeah.
And then I saw somebody was talking about, if I remember, is it like hours worked on average per week? That's started going down, and people said, well, before businesses cut employees, they cut their hours. So this is a potential negative sign for the labor market.
So hours worked have been going down for the past year or so. This is nothing new. And the reason they have been going down is that during the pandemic, they went up to unsustainable level. And the reason they went up is that there was a shortage. In a typical recession, hours work go down. In this recession, our hours worked went up because this was a recession with labor shortage. So we're still close to pre-pandemic level. And I know, that there is a group of people out there who every week, maybe every day, are waiting for the crash in the US labor market. For sure, it will come, but not this month or next.
Right. Okay, great. And for the upcoming week, yeah, what stands out? What should clients, investors be looking out for?
So I think the main event is really how the market absorbs this huge increase in issuance, because in terms of Fed, after Jefferson's comment, market has priced off a hike, and I agree. I mean, the CPI will be released the first day of the Fed meeting, too late to be taken into account. Plus, the Fed doesn't react to single data points, and they've made clear they need yet more evidence that inflation is not slowing. I mean, I'm not quite sure what, will meet their need for evidence, but there we are. They make the decision, not I. So they are not talking this week, and this coming weekend, they are going to wait and see. I mean, this coming meeting. All right, so that's the Fed, not much. In terms of data, we might get a break because this is a week with little going on. Most important data point is the PMI. The consensus sees a small increase, and I kind of agree. Though, the services PMI and GDP have been decoupling since Q4. Usually the services PMI, the employment component is a decent indicator for NFP, but this time around, due to the dates of the release, the NFP got released before the services PMI. The trade
will it be for the same period?
Pardon?
Well, the payrolls, which came out on Friday, and services PMI, and I guess the employment component, is it the same period? Like roughly for the month of May, I guess?
Yeah, I mean, it's not the same week. It's
One's
not the same data set, but it's, yeah. And so not much exciting there. Trade balance, again, this is a goods and services trade balance. Goods trade balance was released last week. It was really bad. Things worsened. I mean, the US is growing very strongly. What do you expect? The trade deficit is widening. Consumer credit, again, this is a data because people are not borrowing, so nothing exciting here. In terms of things to watch for, so Fitch ratings was quite miffed with all this debt ceiling business. So even though we got a last minute deal, they've warned that they could still downgrade the US, but this is a ways away. And to be very honest, I'm not sure many people care. The other thing to look for, but it's not going to happen right away. So it's the issue of student debt forgiveness. There is a good chance it will be stricken by the Supreme Court by the end of June.
Right.
The Supremes have not told us when they intend to do it. And of course, as you know, as part of the debt ceiling deal, there was an agreement to not extend further the debt suspension of repayments, which anyways the administration was not planning on doing. But the interesting story here is that the administration has a plan to change income-driven payments, which they've announced in January and not said anything about since then. And I suspect they probably are waiting for the Supremes to strike the debt forgiveness to come up with a plan that will soften the blow on growth
it may be a decent hit. Well, I guess right now they've suspended payments, but yeah. Do you see that being a decent drag on growth, I guess, in the second half, or?
I mean, a significant one, but not a deal breaker. And also, let's wait and see. I think the administration is definitely not going to have a marked slowdown ahead of a presidential election. So I think their plans for payment modifications that they discussed in January, and then we heard nothing about it. I think they will be revived once the Supreme Court is done dealing with the forgiveness.
Right.
But so it's not an issue for next week, really. It's more of a medium-term issue.
Right.
So
and just on everything that including the debt ceiling deal and anything else, I guess, to go with, do you see government spending in the second half? Is it going to be about what you thought a couple of weeks ago? Is it going to be more of a drag on the economy?
It's going to be a little smaller, but remember the agreement with on the debt ceiling, the expenditure cuts are for FY 2024, so starting in October.
Okay, so yeah. Okay. Okay, cool. Anything else that people should be thinking about? Yeah.
No, I think we're going to have a relaxed week. I'm hoping for one at least. So I hope the money market crash, but not this week. It would be nice to have a couple of weeks of respite.
Okay, great. And I guess for like our professional and kind of wealth, macro wealth clients, just a few things. The macroscope, Bilal's macroscope, which I thought was kind of interesting thing to look into. It's kind of what the consensus got right and got wrong, I guess, including us. And thanks to you, our call certainly on where the Fed would have to go, where we were consistently higher than the consensus has been proven to be true, and also where inflation is. We are obviously higher than the street there again, and that's proven to be correct, and also more bullish on growth. But it's a good, interesting read. I was just actually reading the Oil Weekly, which is very interesting, especially with OPEC plus meeting this weekend. What's the takeaways? You know, is there chances for further cuts? You know, are the major OPEC players even hitting their supply targets that they had agreed on? And then also we had a very interesting piece on the FX option stuff as always. And Henry did a bunch of stuff on I guess the updated PCA analysis of which trades we really like, and that's had a very high success rate, by the way, since launching that model. So a lot of interesting stuff. But overall, obviously want to wish everyone a very nice rest of the weekend. I guess they'll see this Sunday afternoon, and a very kind of enjoyable and profitable upcoming week.
Absolutely.
And obviously, you, Dominique, enjoy the rest of your weekend, and so you're excited to interact from Monday onwards.
Absolutely. Good luck, everybody.
Thank you.